Alex, welcome to Trade Finance Talks TV.
Dipesh, thank you very much for having me. Great to be back.
Great to have you. So here we are in London at the Trade and Investment Forum, thanks to ITFA and BCR Publishing. Can you give us a quick elevator and introduction? So who are you, where are you from, and what do you do?
Yeah, absolutely. First, I want to thank London for being snowy and cold and making me feel very much at home, having flown in from Toronto yesterday. So look, my name is Alexander Malaket. I consult in international trade and trade finance. I've been doing that more years than I care to admit in public. And recently focusing also on international development related work, doing a significant amount of work with my friends at the Asian Development Bank, and then inevitably the ESG and sustainability space with a practice that we founded here in London called ESG Validation. And then finally, we have a group of trade and trade finance specialists, including trade policy and logistics specialists through a firm called Prism Global Partners LLP, which is also based in London. So enough to keep out of mischief.
Absolutely, and I know you love traveling. Let's talk about trade finance as an asset class, and we talk about it a lot. Is it just an exciting buzzword? What's the drive behind trade finance as an asset class?
So look, we talked about this a little bit in the panel this morning in the event, right? It's a multi-year effort, maybe even going back 15 years or more, to try to develop trade finance as a more investable asset class, because there are people investing in it today. There is some momentum in the market from a variety of players, both on the origination side looking to offload and on the investor side looking to invest in various forms of traditional trade finance or open account / supply chain finance mechanisms. So it exists today, and there are people doing significant business, but the question is, can we accelerate the momentum? Can we grow the amount of net new capital flowing into the trade finance space to fund more trade financing, more international trade, and therefore fund both the activity of more SMEs and supply chains and fund more international development in emerging markets? So I'll just quote the often quoted, trade finance gap of 1.7 trillion. Can we help fill that gap somehow by attracting net new capital into the financing of international commerce?
Well, can you talk about that more? How can getting more liquidity into the market help smaller companies access and meet that unmet 1.7 trillion trade finance gap by developing trade finance as an asset class?
Yeah, absolutely. So this gap exists in part because banks, who are traditionally the suppliers of trade financing, just don't have the balance sheet capacity, don't necessarily have the risk appetite, and just we understand that they will never fill all of the demand for trade financing globally that exists today. Whether it's 1.7 trillion, whether it's 2 or 4 trillion, depending which source you quote, it's a big number, whatever it is, right? And we just know the banks by themselves will not fill it. And so the question is, with investors looking for different characteristics for the types of investments they're looking at, things like uncorrelated assets, meaning they behave a little bit differently than the rest of the portfolio, things that relate to real economy activity, which trade finance and trade clearly does, and things that maybe relate to sustainability and ESG, where there's more and more capital flowing into that type of activity. With those features, can we attract some of that capital markets and investment management activity to look at trade finance as an attractive alternative, as an attractive complement to the other activities that are going on, and can we do that at scale? And if we do succeed at that, then can we succeed in having some portion of that financing support the SMEs and support the emerging markets? So that's how that equation kind of plays out.
Uncorrelated assets, I guess you're talking about the counter-cyclical nature of trade finance. Can you expand on that?
Correct. So there's an old quote, trade finance has never met a crisis it doesn't love, something like that. So where certain assets maybe aren't doing necessarily as well in certain cyclical dynamics of the economics globally or regionally, trade finance can counterbalance that behavior. And so from an investment manager perspective or a portfolio management perspective, it can be an attractive complement to some of the other assets that people are investing in.
Sure. And who are the investors? Where do they typically invest their money into capital markets? And why is trade finance on the radar with them? Is it because the yields, trade finance being typically a low yield asset class, is it because the yields are actually seem a bit more interesting now for investors?
So in a high interest rate environment, we heard this morning, clearly the answer is yes to that question, right? But it's also a risk versus return balance. And the story for trade finance, generally speaking, is that it's an attractive asset class from a risk profile perspective, especially from a credit perspective. Now, there have been some huge frauds in the market, so we have to be candid about those as well. And the business of structuring trade finance, whether it's traditional trade finance or the open account supply chain space, can be very complex. There are contractual issues to consider, there are operational risk issues to consider in terms of mistakes being made at the transaction level. So all of these factors, the investor either needs to mitigate effectively or needs to understand well enough, let's say operationally, transactionally, to be able to assess whether the mitigation measures are adequate to protect the investment. So I guess from my perspective, it's a bit of a bridge building exercise between the trade finance practitioners and community and the asset managers and investment management community for both groups to better understand each other and how they function.
Yep. And what needs to happen to build that bridge between those two communities? I hear standardization touted quite a lot in some of these panel discussions.
Yeah, Dipesh. So there are some fundamentals, right? It even goes back as far as saying, do we even speak the same language? Do we understand what each of us is referring to when we use certain terminologies and some language in terms of describing our respective activities? And the answer today is probably broadly no. So even that lexicon and that language is a good starting point. Then in terms of standardization, depends where you apply it, right? These transactions can be very bespoke. They can, again, be very complex in terms of how they're structured. Can we standardize certain aspects of it so that from an investment management perspective, an assessment can be made that is a little bit easier than it is today, a little bit less resource intensive than it is today, and maybe a little bit more comparable to other investment alternatives that these asset managers are looking at in terms of where they place their money?
Sure. And what role can credit ratings agencies play in this?
So this is another one of these recurring thematics on this topic, right? Is it's difficult and expensive to get the credit rating. You can't necessarily attract the investment capital without having the credit rating. It's kind of one of those chicken and egg discussions. So, I mean, the reality is it does get done. It can get done. There's a process for it. It can be very expensive, and the question is it prohibitively expensive? So are there things we can do in the process to make that a bit more viable? Are there things we can do to give a certain level of comfort and trust from the investment community side about what these transactions are so that maybe it's not a make or break conversation? But I'd even go back before this to say there are some real fundamentals we need to address, including the definitions piece, the language piece, the standardizations piece that you talked about. We mentioned also technology being a good enabler of this, helping to make the process of downselling assets and the process of investing in assets hopefully easier, less complex, more cost effective. So that there are some real basics that we need to get at to really scale this whole proposition.
Interesting. And I guess you've talked us through a top-down approach. What about a bottom-up approach? And I'm talking the idea of tokens, tokenization of assets to actually get, smaller investors and investment, but obviously in total it's quite a big liquidity pool into the trade finance market, looking at it that way.
That, in light of what's been happening recently in that space, that's an interesting question. And if you start asking me about whether we can create an NFT related to the financing of international trade, I'm out. So look, the short answer to your question is I think there's some potential there. I don't know whether we can scale it using tokenization. And I'm really more focused on the fundamentals today, even though maybe it's a bit more interesting and a bit more exciting to try to wrap a tokenization conversation around this. I really think there are some fundamentals we need to address first. And then the other piece that's particularly interesting to me is how we bring in the sustainability and ESG part of the conversation into this equation. Because the banks and other financiers are interested in this from an origination perspective, clearly. There is some really significant work going on to try to green and ESG align global supply chains. And then the third piece of that sort of, triumvirate or whatever, is the investors also looking to place more of their money in ESG and sustainability aligned activity and investment. And I think it was BlackRock recently that said, even with the anti-ESG pushback, they still have something like 100 times more flow going into ESG and sustainability aligned funds and investments than not. So, it's still a very serious issue. And if you think about the existential threat of climate, if you think about the social impact of things like human slavery in supply chains and all the sorts of real things that happen in that ESG sustainability space, there's a lot we can do there, and trade finance is an attractive both mechanism to facilitate these things, but also an attractive conduit to bring capital into these sustainable type of activities.
Well, no, that's very interesting. How can we use ESG and sustainability as that anchor to increase capital into the trade finance distribution sphere, say? What are the practical steps that actually need to happen to make this a possibility?
So I know you guys have been watching the ESG space. I mean, this is a hugely dynamic space. Again, you can even go right back to the question of definitions, right? Do we even understand what that means? Do we know what sustainability is? Do we understand what sustainable finance is? And do we even know what sustainable trade looks like? So there's a lot of work going on. The IFRS Foundation and a number of others are looking at standards and looking at talking about climate standards and social standards and so on. So there's that foundational layer. There's the other layer that talks about how do you even identify what type of transaction would qualify as sustainable or climate aligned or ESG aligned? So there are activities in the multilaterals, for example, looking at climate tagging. So if a particular deal is done, whether it's a trade finance deal in the short-term end or an infrastructure transaction, can you tag it as being sustainable or climate related in a way that it helps support the climate commitments that these institutions are making? So if you're able to marry those types of activities that are happening in parallel to say, okay, we can identify the transactions and the business that looks ESG or sustainability aligned, we understand what we're dealing with, and now there's credible data and credible support for these ESG and sustainability claims, because there's a lot of this greenwashing conversation or over-marketing or over-promising kind of thing happening today. Those are a couple of elements of the sorts of activities I think we can bring together to credibly, again, I emphasize that point, link ESG and sustainability to trade finance, and then therefore to the trade finance capital and investment conversation related to ESG and sustainability.
Yeah, exciting, and I think you've clearly highlighted some of the challenges we have to overcome. But I think ESG and sustainability certainly might be a catalyst, right, to open up trade finance as an asset class.
I believe so, yes.
Alex, thank you very much for joining us on Trade Finance Talks TV here at the ITFA BCL Publishing Trade and Investment Forum.
Good to see you, Deepesh. Thanks for having me.
See you in Toronto.
Will do.